I'm going to just kind of start with, to begin with, types of funds, and I'm going to focus on a lot of what we do are private equity funds. And, we're going to talk much more about real estate funds. We do a lot of syndications, a lot of real estate funds in different areas. But most commonly, when people think of a fund, an investment fund, they're thinking of a hedge fund. And a hedge fund means really a private fund. And they kind of come down to three broad categories that I'll dive into a little bit deeper, which is the stock trading hedge fund, which that is truly trading in the markets. It may be trading options, but at the end of the day, it is actively trading and investing through the stock exchanges. With most hedge funds, there's always some component of a management fee, and usually it's 2%. Very classically, it's referred to as a 2 in 20 fund, meaning there's a 2% management fee. But in addition, the investment managers get 20% of the profits, hence the 2 in 20. And I do want to just point out that on an average with most hedge funds, the actual fees or expenses that are charged to the fund are usually around 3.5%. How do you get 3% out of 2% and 20% of the profits? Well, 3.5% actually ends up being 2% for the management fee plus expenses. And expenses generally run around 1.5. That's where the average expense that gets charged to the fund is about 3.5%. And that 20%, we're so used to talking about carried interest. With most hedge funds, it's described more as a performance fee, where if you're managing a hedge fund, you don't actually take ownership in the hedge fund. That creates a dilutive event, a dilution of the investor's interest by 20%. That can cause both tax issues for you and angry investors on the other side. But if you just say, as a performance fee, we're going to charge 20% of the profit, those funds come to you 1099, not necessarily as a capital gain all the time, but that's how we get this 2 in 20 structure. Now, the second type of very similar is a VC fund, a venture capital fund. And this is everything that we always hear about in Silicon Valley. They are the VCs. They're out there investing in the pre-IPO, the technology, the opportunities that, it starts as an idea and they want to make great investments. But you know what? They're not just making investments like most private equity funds. They're adding more to the business. They're bringing the consultants. They're bringing sometimes the staff, the CEOs, the operators. Now, this is actually part of the way that they even make more money. Is oftentimes these venture capital firms, they're only charging to the investors in the fund. That's saying 2 in 20 structure. It's very important for you to always remember to try to stay standard. As long as it looks like the investors are used to seeing, well, then there's no pushback. But at the end of the day, you actually can't run a venture capital firm with only a 2% management fee because there's so much more that goes into it. To talk about kind of operational activities with a hedge fund, we make an investment, the investment sits there. Guess what? The hedge fund manager doesn't do anything else until the decision comes down to sell. But with the venture capital fund, there's the analysis, there's the investment, but then there's all of the extra work that happens, the time, the expenses, the travel, to make sure that the investments prosper, that they're positioned properly, that they have the best team available. And these are additional steps that venture capital firm does. And oftentimes the venture capital management company will actually own an employment company. And that employment company will place the employees with the operations, with the actual, I'm going to invest in your company, but I'm also going to bring these staff from my staffing agency. And guess what? The management will also get paid from that. So there is more profits that come from the venture capital funds beyond just that 2 and 20 basis. However, it generally comes through this staffing. And to give you kind of a hint, even major companies like Google has a staffing agency that funds or places all the staff in Google, its subsidiaries, its investments. And you know what? That staffing agency, it's owned by the principals of Google. It's not part of Google. So it's another way that they make money out of the business, but through having kind of side-by-side operations. This is exactly what happens with venture capital funds as well. And then the last one that I do want to bring up is the private equity funds. Private equity funds, we've all heard about the PE funds. Most commonly, they are still 2 and 20 style hedge funds, just generally investing more in private opportunities rather than the stock market. Oftentimes doing far less trading than a hedge fund usually will. Hedge funds may have a turnover of 100% or 200% per year because they're in and out of opportunities. With a private equity firm, they are different than a venture capital firm because they are far less involved with where they're investing. They're still hoping to just place the money, let the funds grow, and move on to the next opportunity. So with all three of these, they're often being operated as a registered investment advisory firm, usually have management responsibility.